Before we begin, a brief but important disclaimer. I am not a licensed financial advisor, and this video is for educational and informational purposes only. The content presented here should not be construed as financial, legal, or tax advice. The housing market and mortgage products are complex and subject to change. Always consult with a qualified professional before making any major financial decisions. You're scrolling online looking at houses. You see one. It's not a mansion, but it's perfect. The right number of bedrooms, a decent yard, in a neighborhood you actually like. You feel that little spark of hope. Then your eyes drift down to the estimated monthly payment, and your heart sinks. It's a gut punch. With today's home prices and interest rates, that number feels less like a mortgage payment and more like a ransom. The American dream of homeownership feels like it's being auctioned off to the highest bidder, and you've been priced out of the running. It's a frustrating, demoralizing feeling that millions of Americans are experiencing right now. But what if there was another way? A little-known option that could slash that monthly payment by hundreds of dollars. Suddenly, that impossible house becomes possible. The dream is back on the table. This is the seductive promise of the 40-year mortgage, a financial tool that is quietly re-emerging from the shadows of the American housing market. It sounds like a lifeline, doesn't it? A key to unlock a door that seemed permanently bolted shut. Here's the truth they don't put in the brochure. That lifeline could end up costing you an extra $100,000, $200,000, or even more over the life of your loan. It's a trade-off of epic proportions. A little bit of relief on your monthly budget today in exchange for a massive, wealth-crushing mountain of debt tomorrow. So in this deep dive, we are pulling back the curtain on the 40-year mortgage. We're not just going to talk about it, we're going to dissect it. We'll expose the hidden mechanics, run the real-world numbers, and reveal the psychological traps designed to make it seem like a no-brainer. By the time you're done watching, you will understand with absolute clarity whether this is a clever financial strategy for a select few, or a devastating financial trap for the masses. You'll know exactly who is being targeted by these products, and you'll be armed with the knowledge to protect your financial future. So why is this even a conversation right now? Why are we talking about a loan term that most people have never even heard of? The answer is simple. The affordability crisis. We're in a perfect storm. Home prices skyrocketed during the pandemic, and then the Federal Reserve aggressively hiked interest rates to combat inflation. The result? The cost of financing a home has exploded. The principal and interest payment on a medium-priced home today is more than double what it was just a few years ago. People's wages have not doubled, so the market is seized up. Buyers can't afford the payments, and sellers who have low, 3% mortgage rates are locked in, unwilling to move and take on a new 7% rate. This is where the government and the lending industry get creative. In early 2023, the Federal Housing Administration, the FHA, floated a proposal to allow 40-year terms for their loan modification programs. Now, this was intended for borrowers in distress to help them avoid foreclosure. But it opened Pandora's box. It legitimized the 40-year mortgage in the public consciousness. And you can bet that wherever there's a government program, private lenders are watching, taking notes, and figuring out how to package and sell a similar product to the general public. They see a market of desperate buyers, and they are crafting a product that preys on that desperation. Let's get right into the brutal math because numbers don't lie. Let's imagine a modest home at a price of $400,000. We'll assume a 20% down payment, so you're borrowing $320,000. Let's use a hypothetical interest rate of 7%. Which has been a common rate recently. With a standard 30-year fixed mortgage, your monthly principal and interest payment would be about $2,129. Over 30 years, you will pay a staggering $346,000 in interest. That's more than the original loan amount. It's a tough pill to swallow, but it's the standard we've all come to accept. Now let's stretch that same loan out over 40 years. The sales pitch is the monthly payment. Your new payment would be about $1,962. That's a savings of $167 a month. For a family struggling to qualify or make ends meet, that $167 feels like a huge win. It could be a car payment, groceries, or childcare. It's the difference between getting approved and getting denied. It's the relief you were looking for. But here is the devastating cost of that relief. Over the course of that 40-year loan, the total interest you would pay is not $346,000. It's $521,000. Let me repeat that. $521,000. By extending your loan for just 10 extra years, You have agreed to pay an additional $175,000 in pure interest to the bank. That is a life-changing amount of money. It's a college education for your kids. It's a comfortable retirement. It's a business you could have started. And you've handed it over to the bank, all for the illusion of saving $167 a month. This is the central deception of the 40-year mortgage. It sells you on the monthly payment while hiding the catastrophic lifetime cost. But the cost isn't just measured in total dollars. It's also measured in the slowest, most painful wealth-building process imaginable. I'm talking about equity. Equity is the portion of your home that you actually own. It's your home's value minus your mortgage balance. It's the primary way the American middle class has built generational wealth for decades. With a mortgage, especially in the early years, the vast majority of your payment goes toward interest, not principal. This is called amortization. On a 30-year loan, this is already a slow process. But on a 40-year loan, it's glacial. It's like trying to fill a bucket with a tiny hole in the bottom. You're pouring money in every month, but almost all of it is leaking out in the form of interest payments to the lender. Let's go back to our example. After 5 full years of making payments on that 30-year mortgage, that's 60 payments totaling over $127,000, you would have paid down your principal by about $24,000. It's not great, but it's something. You're building equity. Now look at the 40-year loan. After 5 years, making 60 payments totaling over $117,000, you would have paid down your principal by a measly $14,000. Almost $10,000 less equity for nearly the same amount of money out of your pocket. You're barely making a dent in the loan. You're essentially renting your home from the bank, and your landlord is charging you an astronomical fee for the privilege. If home prices dip even slightly in those first few years, you could find yourself underwater, owing more on your mortgage than your house is even worth. This is the exact scenario that trapped millions of Americans and led to the 2008 financial crisis. These exotic loan products, designed to make homes seem more affordable, created a foundation of sand that crumbled at the first sign of trouble. The danger here is profound because it fundamentally alters the relationship you have with your home. It shifts it from being an asset that builds your wealth to a liability that drains it. The very tool that was meant to be a stepping stone to financial security becomes an anchor, weighing you down for an extra decade. And for what? For a payment that's only slightly lower. But the real danger isn't just the interest or the slow equity. It's what this does to your freedom, to your options, and your ability to navigate life's inevitable changes. There's a specific reason these loans are being pushed on a certain type of buyer, and understanding that is the key to not becoming a victim of this financial trap. So let's pull back the curtain. The buyer being targeted by the 40-year mortgage isn't a seasoned investor or a wealthy individual looking for a creative financing tool. It's you, or maybe your kids. It's the first-time homebuyer, the young family, the person who has been diligently saving, watching prices climb, and feeling the American dream slip just out of reach. It's the person who is emotionally exhausted from the housing market. They've been outbid a dozen times, they've seen interest rates double, and they are desperate for a lifeline. And right when they're about to give up, the lender slides a new piece of paper across the table. They don't call it a financial trap. They call it a solution. They call it affordability. This is the single most dangerous word in real estate today, because what they are selling you is not true affordability. It is the illusion of affordability. They have identified the one number you are laser-focused on, the monthly payment. They know that if they can just get that number low enough to fit into your budget, your brain will shut off. Your relief will overwhelm your skepticism. And that's the moment the trap springs shut. Let's use some real, hard numbers because this is where the mirage evaporates. Imagine a medium-priced home in the US. Let's call it $400,000. With a standard 30-year fixed mortgage at a 7% interest rate, your principal and interest payment would be somewhere around $2,660 a month. For many people right now, that is just too high. It's a budget breaker. So the lender says, I have a solution. Let's switch you to a 40-year mortgage. They might even have to bump the interest rate up a little, say to 7.5%, because longer loans are riskier for them. But don't worry, they say, look at the monthly payment. Suddenly, that payment drops to around $2,500 a month. You've just saved $160 a month. It doesn't sound like a lot, but in a tight budget, it feels like a victory. It feels like the difference between getting the house and walking away empty-handed. You see that lower number and you feel like you just hacked the system. But you didn't hack the system. The system just hacked you, because you weren't focused on the other numbers. the ones they don't print in bold. Over the life of that 30-year loan, you would pay about $558,000 in total interest. An enormous sum, but standard. Now look at the 40-year loan. That $160 you saved each month? It ends up costing you an additional $362,000 in interest. Let me say that again. To save $160 a month, you pay an extra $362,000. You could buy a whole other house in many parts of the country for the extra interest you're paying. You haven't made the house more affordable. You've just made it astronomically more expensive over a longer period. You've locked yourself into a 40-year financial sentence for a moment of short-term relief. But here is the most insidious part of the trap. The detail that truly turns this from a bad deal into a potential catastrophe. It's what happens in the first decade of the loan. It's a concept called amortization, and understanding it is like seeing the matrix for the first time. When you make a mortgage payment, it's split into two buckets: principal and interest. Principal is the money that actually pays down your loan and builds your ownership stake, your equity. Interest is the fee you pay the bank for the privilege of borrowing their money. In any long-term loan, the payments are heavily front-loaded with interest. But with a 40-year mortgage, this effect is put on hyperdrive. For the first 10 years of that 40-year loan we just discussed, you will make over $300,000 in payments. You'll write a check every single month on time for a decade. And at the end of those 10 years, how much of your $400,000 loan will you have actually paid off? You'll have paid off about $32,000. Over 90% of every dollar you paid for 10 straight years didn't go towards owning your home. It vanished into the bank's profit column. You've essentially been a renter, but with all the responsibilities of an owner. You pay for the new roof, you fix the broken water heater, you pay the property taxes, but your actual ownership stake has barely moved. You are treading financial water, furiously kicking your legs just to stay in the same place while the current of interest pulls you under. Compare that to the 30-year loan. In the same 10-year period, you would have paid off over $65,000 in principal. That's more than double the equity. It's still a slow start, but it's a meaningful, tangible stake in your property. That equity is your wealth. It's your financial leverage. It's your safety net. With the 40-year mortgage, that safety net is shredded. This is a calculated psychological play. Lenders understand human nature. They know we are wired to prioritize immediate gratification and avoid immediate pain. The pain of a high monthly payment today feels much more real and threatening than the abstract, far-off pain of paying an extra $300,000 over a lifetime. They are weaponizing our own cognitive biases against us. They are selling the sizzle of a low payment, knowing full well the steak is rotten. They are preying on the desperation that the current market has created, a market they helped engineer. This isn't happening in a vacuum. These loans are being pushed now for a very specific reason. With high home prices and high interest rates, the pool of qualified buyers is shrinking. Transaction volume is down. The entire real estate industrial complex, lenders, agents, builders, needs to keep the machine running. They need to keep qualifying people for loans they otherwise couldn't get. The 40-year mortgage isn't a tool for the buyer's benefit. It's a tool to artificially inflate the buyer pool to keep demand high and to keep prices from correcting. It's a patch, a gimmick to keep the party going, and the homebuyer is the one who will be left with the hangover for the next half-century. So you've signed the papers. You've gotten your affordable payment. You move in, and for the first few years everything seems fine. You're making your payments, living your life. But you're building equity at a glacial pace. You're effectively renting from the bank, with almost no path to real ownership in sight. And this creates a hidden fragility in your financial life, a weakness you won't even notice until the moment you need to be strong. What happens when life does what life always does? What happens when you get a dream job offer in another state, or your family grows and you need a bigger house, or a recession hits and you lose your job? What happens when you need to sell? This is where the illusion of affordability shatters, and the grim reality of being trapped truly begins. Let's imagine a scenario. Let's call him David. David is a young professional, maybe a graphic designer or an IT specialist. In 2024, he finally scrapes together enough for a down payment on a modest starter home. It's listed for $450,000. The bank, seeing a tight budget, offers him a solution: the brand new 40-year mortgage. His payment on a 30-year loan would be tight, around $2,800 a month, but with the 40-year, it drops to about $2,600, $200 a month. To David, that's breathing room. It's the difference between eating ramen noodles and being able to go out once in a while. Feels like a smart, responsible choice. He signs the papers, gets the keys, and feels the immense pride of owning a piece of the American dream. For 5 years, he lives in the house. He pays his mortgage on time every single month. 60 payments like clockwork. Then life happens. He gets an incredible job offer. A dream position, a significant promotion, a huge pay bump, but it's across the country. It's a no-brainer. He has to take it. So he calls a realtor, ready to sell his house and move on to the next chapter. He pulls up his latest mortgage statement to see how much he owes, expecting to see a decent chunk of his loan paid off. After all, he's poured over $158,000 into this house over 5 years. And that's when his stomach drops. He stares at the screen, blinking. He reads the number again. His remaining loan balance is $434,500. He does the math in his head. It can't be right. He paid the bank over $158,000, but his loan balance has only decreased by $15,500. Feels like a typo. A cruel joke. Where did the other $143,000 go? It vanished. Poof. Eaten alive by interest. This is the first and most brutal trap of the 40-year mortgage, the equity desert. In a traditional 30-year mortgage, the first few years are already heavily skewed towards paying interest. But when you stretch that timeline out by another decade, that front-loading of interest becomes absolutely catastrophic. For the first 5, 10, even 15 years, your monthly payments are doing almost nothing to build your ownership stake in your own home. You are essentially just renting your house from the bank, but with the added bonus of being responsible for the leaky roof and the broken water heater. Now let's compare David's situation to his neighbor Sarah. Sarah bought a similar house at the same time for the same price, but she gritted her teeth and took the 30-year mortgage. Her payment was $200 higher, a sacrifice she felt every month. After those same 5 years, she's paid in about $170,000. But her remaining balance? It's $421,000. She has paid off $29,000 of her loan. It's not a fortune, but it's nearly double the equity David has. That $200 difference per month resulted in double the ownership. But this is where the trap snaps shut. David needs to sell. Let's assume the housing market has been completely flat for those 5 years. No boom, no bust. His house is still worth the $450,000 he paid for it. To sell a house, you have to pay selling costs. There are realtor commissions, title fees, transfer taxes. A conservative estimate is around 7% of the sale price. 7% of $450,000 is $31,500. So, David sells the house for $450,000. The first thing that gets paid off is his remaining mortgage, $434,500. That leaves him with $15,500. But wait. He still has to pay the $31,500 in selling costs. He's short. He is $16,000 in the hole. After 5 years of perfect on-time payments, to move for his dream job, David has to write a check for $16,000 to the bank, just for the privilege of selling the home he thought he owned. He is literally paying to be homeless. He is trapped. What about Sarah with her 30-year loan? She sells for $450,000. She pays off her $421,000 loan. That leaves her with $29,000. After she pays the same $31,500 in selling costs, she's still short by $2,500. It's a painful loss, no doubt, but it's a manageable inconvenience. David's situation is a financial catastrophe. He doesn't have $16,000 sitting around. His only options are to turn down the job of a lifetime, or to try and rent out his house and become a long-distance landlord, a nightmare in itself. But let's be realistic. The housing market is rarely flat. It moves. What if, over those 5 years, the market saw a very modest, very normal correction of just 5%? David's $450,000 house is now worth $427,500. His loan balance is still $434,500. He is now officially underwater. He owes more on the house than it is worth. Even if a magic fairy waived all selling costs, he would still need to bring $7,000 to the closing table. Add in the real-world selling costs, about $30,000 on the new lower price, and David is now staring at a financial black hole of nearly $40,000. Selling is not an option. Moving is not an option. He is shackled to a property that is draining his wealth and his freedom. This isn't a bug in the 40-year mortgage. It's a feature. These loans are built on the fragile assumption that you will live in the same house for decades and that property values will only ever go up, and go up significantly. But that's not how modern life works. The average American moves every 5 to 7 years. We change jobs, our families grow, we face unexpected hardships. The 40-year mortgage disregards this reality. It creates a financial prison with invisible bars, a structure that looks like a home but functions like a ball and chain. It strips away your mobility, your flexibility, and your ability to react to life's opportunities and emergencies. The lower monthly payment isn't a benefit, it's the bait. It lures you into a position of extreme vulnerability, where even a minor dip in the market or a normal life event can trigger a financial crisis. You become house rich on paper, but equity poor in reality, a serf on your own property. So you're trapped. You can't sell. But what if you decide to just stay put and ride it out? Surely, if you just keep making the payments, it all works out in the end, right? Well, that's when you discover the second, even more insidious trap hidden inside the 40-year mortgage. The colossal wealth-destroying power of compound interest working against you. We've all heard of compound interest. It's the eighth wonder of the world, the magic force that turns a small acorn of an investment into a mighty oak of a retirement fund. We're told to start investing early, to let our money work for us, to harness the incredible power of compounding. But what happens when that magic is turned against you? What happens when you're not the one earning the interest but the one paying it? That, my friends, is the dark side of compounding, and the 40-year mortgage is its perfect weapon. To understand the sheer scale of this financial trap, we need to do some math. Don't worry, I'll make it simple. Let's imagine a typical American homebuyer. Let's call her Sarah. Sarah is looking to buy a home and needs a loan of $400,000. The current interest rate is, let's say, a flat 7%. First, Sarah looks at the standard tried-and-true 30-year fixed mortgage. Her monthly principal and interest payment would be about $2,661. Over the course of those 30 years, if she makes every single payment on time, she will pay the bank a total of $958,000. That means she paid the original $400,000 for the house, plus a staggering $558,000 in interest. That's already a tough pill to swallow, but it's the standard cost of doing business in real estate. But then her lender presents a tempting alternative, the new 40-year mortgage. With this product, her monthly payment drops to just $2,505. That's a savings of $156 every single month. To Sarah, who is trying to balance a budget, this sounds fantastic. That's the gas bill covered. That's the streaming services and a nice dinner out. Feels like breathing room. Feels like a smart move. But this is precisely where the trap is sprung. For that $156 monthly discount, what is the ultimate price? Let's run the numbers. With the 40-year loan, Sarah will make 480 payments instead of 360. Her total payout to the bank is no longer $958,000. It balloons to over $1.2 million. Let that sink in. The total interest she pays skyrockets from $558,000 to over $802,000. By choosing the 40-year mortgage to save $156 a month, Sarah has agreed to pay the bank an extra $244,000 in pure interest. For the price of that extra interest, you could buy a second house outright in many parts of the country. You could fund your entire retirement. You could put multiple kids through college. It is a catastrophic amount of wealth, transferred directly from your family's future into the bank's pocket. And here's where it gets even more insidious. The damage isn't just at the end of the loan. It's baked into every single payment you make from day one. This is because of something called an amortization schedule. It's the roadmap for your loan, showing how much of each payment goes to interest versus how much goes to paying down your actual principal, the money you borrowed. In any long-term loan, the early years are heavily front-loaded with interest. The bank gets its profit first. With a 30-year mortgage, this is already painful. In your first year, over 85% of your payments are just interest. But with a 40-year mortgage, it's even worse. Let's go back to Sarah. 5 years into her mortgage, she's been a perfect homeowner, never missing a payment. Let's see where she stands in both scenarios. If she chose the 30-year mortgage after 5 years of payments, a total of $159,000 paid to the bank, she would have paid down about $23,000 of her principal. Her loan balance would be $377,000. It's slow, but it's progress. She's building equity, Now let's look at the 40-year mortgage. After those same 5 years, having paid the bank a total of $150,000, her loan balance is still a shocking $388,000. She has only paid off $12,000 of her principal. More than 92% of every dollar she sent to the bank for 5 straight years vanished into thin air as interest. She has been working, sacrificing, and paying, but her actual ownership stake in her home has barely budged. She's been treading water so violently she feels like she's swimming, but she's barely moved from the shore. This is the second trap in action. It's not just about the total cost, it's about the cripplingly slow pace of wealth creation. Your home is supposed to be your primary asset, your bedrock of financial security. The 40-year mortgage turns it into a deadweight for decades, a financial black hole that consumes your income while giving you almost nothing in return. But the true gut-wrenching cost of this loan isn't measured in the extra interest or the slow equity. It's measured in time. It's measured in what we can call the lost decade. Those final 10 years of payments from year 31 to year 40 are the most expensive years of your life, even if you don't realize it. Think about the typical person's career arc. Those years when you're likely in your 60s or even early 70s should be your peak freedom years. Your 30-year mortgage would be paid off. That massive monthly payment would suddenly be back in your pocket. You'd be entering retirement debt-free, with the ability to supercharge your investments, travel, and enjoy the fruits of your labor. With a 40-year mortgage, that freedom is a mirage. Instead of investing that $2,500 a month into your retirement, you are still sending it to the bank. For 10 solid years, an entire decade where your peers are compounding their wealth for a comfortable old age, you are still grinding away to pay for a decision you made 40 years earlier. What is the cost of that lost decade? Let's be conservative. If instead of making mortgage payments you invested that $2,500 every month for those 10 years and got a modest 8% return from the stock market, how much would you have? You'd have an extra $458,000 in your retirement account. Now we see the true cost. It's not just the extra $244,000 in interest. It's that, plus the nearly $500,000 in lost investment growth. The total financial swing, the true cost of saving $156 a month, is over $700,000. It is a multi-generational mistake, a financial anchor that drowns not only your retirement dreams, but the potential legacy you could leave for your children. Fundamentally alters the deal. The American dream of homeownership was never just about having a place to live. It was about owning an asset, building equity, and achieving a level of financial security that frees you from the monthly grind. The 40-year mortgage perverts this dream. It ensures the bank, not you, reaps the vast majority of the financial reward. It shifts the model from homeownership to a state of near-permanent home rentership, where your landlord just happens to be your lender. But surely the banks and lenders have your best interests at heart, right? They're just offering a helpful option for affordability. Or are they? What if I told you this entire product is engineered based on one cold hard calculation about you, and it has nothing to do with you successfully paying off your home? It's a calculation that has everything to do with time, but not the 40 years you're signing up for. It's about the 7 years they expect you to stay. Let me say that again. The entire financial architecture of a 40-year mortgage is built on the statistical certainty that you, the average American homeowner, will sell your house or refinance your loan in roughly 7 to 10 years. They are not underwriting a 4-decade commitment. They are underwriting a 7-year interest harvesting machine. To understand why this is so brilliant for them and so devastating for you, you need to understand the single most important and most misunderstood concept in homeownership: amortization. It sounds like a boring technical term, but I promise you this is where the magic trick happens. This is the secret behind the curtain. Amortization is simply the schedule of how your loan is paid off over time, breaking down how much of each monthly payment goes toward the principal, the actual money you borrowed, and how much goes to interest, the bank's profit. In any standard loan, the payments are heavily front-loaded with interest. In the early years, you are paying almost exclusively for the privilege of borrowing the money. A tiny, almost insulting fraction of your payment actually goes to chipping away at the mountain of debt you owe. As the years go by, the scale slowly tips. More goes to principal, less to interest, until the final years when you're mostly paying down the loan itself. Now let's put this into the real world. Imagine 2 families, the Millers and the Thompsons. Both are buying identical houses for $450,000. They each put down $50,000, and they both need a mortgage for $400,000. And for the sake of a clean comparison, let's say they both get the exact same interest rate. 6.5%. The Millers, being traditional, opt for a standard 30-year fixed-rate mortgage. Their monthly principal and interest payment comes out to about $2,528. The Thompsons, wanting to lower their monthly bill to have more cash on hand, are lured in by the new 40-year mortgage. Their payment is significantly lower, just $2,277 per month. That's a savings of $251 every single month. Over a year, that's more than $3,000 back in their pocket. On the surface, the Thompsons feel like they've made the smarter choice. They got the same house for less money each month. They're winning, right? Now let's fast forward. Let's go to that 7-year mark, the magic number the banks are betting on. Both families get new job opportunities in a different state and decide to sell their homes. Let's look at the Millers first, with their 30-year loan. For 7 years, they've been diligently making their $2,528 payments. How much of their original $400,000 loan have they paid off? After 84 payments, they have paid down their principal by $38,200. Not amazing, but it's a solid chunk. Their remaining loan balance is $361,800. If they sell the house for the same price they bought it, they walk away with their original $50,000 down payment plus that $38,200 in equity. They have $88,200 to put toward their next home. Now let's turn to the Thompsons. They've been enjoying that extra $251 a month. They've been making their lower $2,277 payments for the same 7 years. How much of their $400,000 loan do you think they've paid off? The answer is sickening. After 7 years, the Thompsons have paid down their principal by only $18,900. Let that sink in. For 7 full years of payments, 84 payments totaling over $191,000. Less than $19,000 actually went to owning their home. Over $172,000 vanished into thin air as pure interest. Pure profit for the lender. So when the Thompsons sell their house, they get back their $50,000 down payment, plus a meager $18,900 in equity. They walk away with $68,900. The Millers have almost $20,000 more to show for their 7 years of homeownership. $20,000. That's a new car. That's a year of college tuition. That's a massive head start on the down payment for their next home. The Thompsons, by choosing the more affordable option, effectively lit $20,000 on fire. They paid a $20,000 penalty for the privilege of saving $251 a month. This isn't an accident. This is the design. The 40-year mortgage stretches that front-loaded interest period for so long that you spend the most likely period of your ownership, those first 7 to 10 years, building virtually no equity. You are essentially paying rent to the bank. You have the illusion of ownership, the responsibilities of ownership, the property taxes and the leaky faucets of ownership, but you get almost none of the primary financial benefit, building wealth through equity. The bank, on the other hand, wins big. They collect a massive guaranteed stream of pure interest from you. Then, right when your payments would finally start making a real dent in the principal, you sell the house and they get the rest of their money back. They've taken on very little risk and extracted the maximum amount of profit in the shortest amount of time. Then the next person buys the house and the cycle begins all over again. This transforms the American dream of homeownership into something more like a subscription service. The low monthly payment is the seductive introductory offer, but the terms and conditions buried in that amortization schedule are designed to keep you paying for a service, the service of living in a house, while minimizing your ability to ever truly own the product. You're running in place on a treadmill of debt, and the bank is setting the speed. You feel like you're moving forward because you're making payments every month, but your financial position barely changes. Think about the long-term consequences. When the Thompsons go to buy their next house, they are starting from a much weaker position than the Millers. They will need a larger loan. They will have less flexibility. They are further behind in the race to build generational wealth. The 40-year mortgage didn't just cost them $20,000 in equity. It cost them momentum. It cost them years of financial progress. This is the cold, hard calculation. The banks aren't betting on you paying off your home in 40 years. They're betting on you behaving like a typical American. They're betting on you moving, on you refinancing, on your life changing within a decade. And they have engineered a product that ensures when you do, they will have already squeezed the maximum profit out of you, leaving you with the minimum to show for it. It's a masterclass in financial engineering, where your own predictable life patterns are used to design a trap. And the scariest part? This amortization trap is just the most basic, fundamental danger. We haven't even begun to talk about the truly toxic features that are often baked into these loans. The hidden clauses and ticking time bombs designed to make this situation even more precarious for the homeowner. Because what happens when the loan isn't a simple fixed rate? What happens when the stability you think you're buying is actually an illusion? That stability is shattered the moment we introduce two little words: adjustable rate. Welcome to the trap within the trap. The 40-year adjustable rate mortgage, or ARM. This isn't just a longer loan. It's a completely different beast. A chameleon that changes its colors and its cost when you least expect it. On the surface, it looks like a godsend. Imagine you're trying to buy that same $400,000 house. With a fixed 40-year loan at 7%, your payment was already pushing the limits of affordability. But then the lender presents you with a magical option. A 40-year ARM with an introductory teaser rate of just 4.5%. Suddenly, your monthly payment plummets. It's no longer a struggle. It's comfortable. The dream home is back on the table. The lender smiles, assures you it's a standard product, and points to the initial low number. This gets you in the door, they say. And they are absolutely right. Gets you in the door, and then it locks it behind you. Because that teaser rate is exactly what it sounds like: a temporary lure. It's typically fixed for a short period, maybe 3, 5, or 7 years. During that time, you feel like you've won the lottery. You're paying hundreds less than everyone else. You're building a life in your new home. You forget about the fine print. But the bank never forgets. When that introductory period ends, your loan enters a new phase. Your interest rate is no longer fixed. Instead, it resets periodically, usually once a year. And how is this new rate calculated? It's not arbitrary. It's tied to a financial index, something like the Secured Overnight Financing Rate, or SOFR. The bank takes the current value of that index and adds their own non-negotiable slice on top, which is called the margin. So your new rate is index plus margin. If the index is at 5% and the bank's margin is 2.5%, your new interest rate is 7.5%. Let's pause and think about what that means. Your financial fate, the single biggest bill you pay every month, is now tethered to global economic forces completely outside of your control. It's a passenger on the roller coaster of interest rates, and you're strapped in for the ride for the next 35 years. The bank protects itself with something called caps. There's usually a cap on how much your rate can increase at the first adjustment, a cap on how much it can increase in subsequent years, and a lifetime cap on how high it can ever go. These are presented as safety features for you, the borrower. They are not. They are the guardrails on the bank's highway to profit, ensuring they can systematically extract more from you over time without causing an immediate, catastrophic default. Let's go back to our homeowner. Their 5-year introductory period at 4.5% is over. They've been paying faithfully for 60 months. But because of the slow amortization of a 40-year loan, they've barely made a dent in their principal. They still owe an enormous amount of money. Now the rate resets. Let's say the index and margin push their new rate to 7.5%. That's a 3 percentage point jump. Their monthly principal and interest payment doesn't just nudge up. It explodes. It could easily jump by 40, 50, or even 60% overnight. This is called payment shock, and it's a financial heart attack. The comfortable payment that allowed them to buy the house is gone, replaced by a number that suffocates their budget. Every plan they had, saving for retirement, a college fund, even a family vacation, is now in jeopardy, all sacrificed to feed the mortgage. But this is where the story takes an even darker turn, because the most insidious versions of these 40-year loans come with a feature so dangerous, it's a miracle it's even legal. It's called negative amortization. Let that sink in. Negative amortization. It means your loan balance can actually go up, even while you are making your monthly payments. How is this possible? The answer is a cascade of failures. A domino effect that starts not with a bang, but with a whisper. It begins with something that seems entirely normal in a dynamic economy. A regional slowdown. Imagine a major tech company in Austin, or a manufacturing hub in the Midwest, announces layoffs. It's not a national crisis, just a localized downturn. Thousands of people lose their jobs. Among them are hundreds of families who just 2 or 3 years prior stretched every last dollar to buy a home using a 40-year mortgage. Under normal circumstances, a job loss is a crisis, but for a homeowner, there are usually options. You can sell the house. Maybe you break even, maybe you make a small profit, but you get out from under the massive debt and can relocate for a new job. But for these families, selling isn't an option. After 3 years of payments on a 40-year loan, they've built almost zero equity. The vast majority of their payments have gone straight to interest. In fact, if home prices in their area have dipped by even a mere 3 or 4% due to the local economic slump, they are now officially underwater. They owe the bank more than the house is worth. They are trapped. They can't sell because they don't have the tens of thousands of dollars in cash needed to pay the bank the difference. They can't refinance because no lender will touch an underwater mortgage, especially with no income. Their only path is foreclosure. And so the first domino falls. Now multiply this scenario. It's not one family. It's hundreds in that single town. The bank which now owns these homes has a problem. They aren't in the business of being landlords. They need to get these assets off their books. So they start listing these foreclosed properties for sale, often at a discount just to get them sold quickly. Suddenly, the local housing market is flooded with cheap inventory. What does this do? It instantly craters the property values for everyone else in the neighborhood. Your neighbor, who still has their job and has been making their 30-year mortgage payments on time, suddenly gets their new property tax assessment. They see their home's value has plummeted by 15% in 6 months. Their primary source of wealth has just taken a massive hit. They might not be in immediate trouble, but they start to feel a lot less financially secure. They stop spending money on renovations, they put off buying a new car, they eat out less. The local economy, already reeling from the layoffs, takes another body blow. This is the contagion. The initial foreclosures, driven by the unique vulnerability of 40-year mortgages, create a feedback loop. Lower prices put more people underwater, even those with more traditional loans. This makes the entire housing stock in the area more fragile. Now the next person who gets a pink slip, who might have otherwise been able to sell their home and weather the storm, finds that they too are trapped. They too are forced into foreclosure. The cycle accelerates. What started as a localized problem in one city doesn't stay there. In our interconnected financial system, that risk is packaged and sold. The bank that issued those 40-year mortgages in Austin didn't just keep them on its own books. It likely bundled them together with thousands of other mortgages from all over the country into something called a mortgage-backed security, or MBS. This is a complex financial product that is then sold to investment funds, pension plans, and other banks across the globe. The investors who bought these securities were told they were safe. They were probably assigned a high rating by a credit agency, based on the assumption that the U.S. housing market is stable. But buried deep inside that security is a concentrated dose of poison. A batch of 40-year mortgages from a town that is now experiencing a foreclosure crisis. As those loans start to default, the value of that entire security begins to crumble. Now, a pension fund in California or an investment bank in New York is taking unexpected losses. They get nervous. They look at their other investments and realize they're holding similar mortgage-backed securities, filled with other high-risk, low-equity 40-year loans from other parts of the country. They don't know which ones will go bad next, so they start selling all of them. It's a fire sale. This widespread selling puts immense pressure on the entire financial system. The value of these securities plummets, and the market for them freezes up. This is critical, because this market is the engine of home lending in America. When it freezes, the banks that rely on selling these securities to raise cash for new loans suddenly can't. So what do? They stop lending. Or, at the very least, they tighten their standards so dramatically that only the wealthiest, most pristine borrowers can get a loan. And just like that, the credit spigot for the entire U.S. housing market is turned off. The national housing market, which was chugging along just fine, grinds to a halt. Potential buyers can't get loans. Sellers can't find buyers. The number of transactions plummets. And with demand artificially choked off, prices begin to fall. Not just in the one town that had layoffs, but everywhere. This is the systemic risk of the 40-year mortgage. It's not just a bad deal for the individual borrower. It's a structural weakness injected into the foundation of the market. It removes the most important shock absorber a homeowner has: equity. Home equity is what allows a family to weather a job loss, a medical emergency, or a local downturn. It provides flexibility and resilience. By extending the loan term to 40 years, lenders and desperate buyers have systematically stripped out this resilience from an entire cohort of new homeowners, replacing it with decades of profound fragility. They've created a class of homeowners who are, for all practical purposes, renters with a mortgage. They have all the responsibilities of ownership, the taxes, the insurance, the leaky roof, but none of the financial stability that equity provides. They are leveraged to the absolute maximum, one unexpected expense away from disaster. And when you build a significant portion of your housing market on such a fragile foundation, it doesn't take an earthquake to bring it down. A simple change in the weather is enough. The terrifying part is how this mirrors the lead up to 2008, but with a devious twist. Back then, the ticking time bomb was the adjustable rate mortgage, where payments would suddenly explode. The danger was obvious even if people chose to ignore it. Today, the danger is quieter, more insidious. The 40-year mortgage doesn't explode. It just suffocates. It offers a low, stable payment that lulls the borrower into a false sense of security, all while keeping them in a state of maximum vulnerability for a decade or more. It's a silent killer for the homeowner's balance sheet. And as this product becomes more mainstream, as it moves from the fringes of non-qualified mortgages to potentially being blessed by government agencies, we are multiplying the systemic risk on an unprecedented scale. We are encouraging a generation to buy the most expensive asset of their lives with a product that is perfectly designed to fail at the first sign of economic trouble. We are setting the stage for a crisis where millions of homeowners could find themselves trapped, with foreclosure as their only exit. But what if there's another layer to this? What if the very institutions promoting these loans have already figured out how to profit from the inevitable fallout? It's a chilling question, isn't it? The idea that the same system offering you a lifeline might also be building a net to catch the profits when that line snaps. The answer isn't a conspiracy theory whispered in dark corners of the internet. It's a business model, written in plain sight within the complex architecture of modern finance. And it all starts with a process that sounds deceptively simple: securitization. You see, when you sign that 40-year mortgage, you're not just entering into a simple agreement with your local bank. In the vast majority of cases, your bank doesn't hold on to your loan for 40 years. That's far too long, far too risky, and frankly not profitable enough. Instead, your loan, your promise to pay, your piece of the American dream becomes a product. It gets bundled together with thousands, sometimes tens of thousands, of other mortgages from all across the country. Good credit scores, bad credit scores, 30-year loans, 40-year loans, they're all thrown into a giant financial blender. The concoction that comes out is called a mortgage-backed security, or MBS. This financial smoothie is then sliced up into different pieces or tranches and sold off to investors on Wall Street and around the globe: pension funds, hedge funds, foreign governments. The bank that originated your loan gets its money back almost immediately, plus a tidy fee. They've successfully passed the long-term risk on to someone else. They are now free to take that money and make another loan to another family, earning another fee, repeating the cycle over and over. Does any of this sound familiar? It should. This is the exact same machinery that brought the global economy to its knees in 2008. Back then, the toxic ingredient in the smoothie was the subprime mortgage. This time, the concern is that the 40-year mortgage, especially when used as a loan modification tool for distressed borrowers, could become subprime 2.0. It's a loan designed for affordability, not for successful repayment of principal. It's a product that keeps people in their homes just long enough for the financial system to extract maximum value before a potential default down the line. But here's the crucial difference between now and 2008, and it's a twist that should concern every single American taxpayer. After the crash, the government stepped in to backstop the entire system. Today, an enormous percentage of these mortgage-backed securities are guaranteed by government-sponsored enterprises, Fannie Mae and Freddie Mac, or insured through the Federal Housing Administration, the FHA. What does that guarantee actually mean? It means that if you, the homeowner, default on your 40-year mortgage, and that mortgage is sitting inside a security guaranteed by Fannie or Freddie, the investors who bought that security don't lose their money. The government, meaning you, the taxpayer, steps in to make them whole. The risk hasn't vanished. It has been transferred. It's been socialized. The profits remain private, but the losses become a public burden. The very institutions creating and selling these high-risk products are insulated from the consequences of their failure. They've built a system where they can't lose. But the profit-making doesn't even stop there. It gets even more insidious when you look at the role of the mortgage servicer. The servicer is the company you send your monthly check to. They handle the administrative side of your loan. Crucially, the servicer is often a different entity from the one that owns your loan. The investors who own the MBS don't want to deal with collecting payments from millions of individual homeowners. So they hire a servicer to do it for a fee. And here is the dirty little secret of the mortgage servicing industry. They can make more money when you're in trouble than when you're paying on time. When a borrower is current, the servicer collects a small, fixed percentage of the loan balance. It's a steady but low-margin business. But the moment a borrower falls behind, a whole new world of fees opens up. Late fees, property inspection fees, broker price opinion fees, force-placed insurance fees, legal fees for foreclosure proceedings. Each one of these is a revenue stream. Think about that. The entity you communicate with, the one you plead with for a modification, has a direct financial incentive to keep you in a state of delinquency. They are a collector, and their profits are maximized through the collection of penalties. In this model, a 40-year loan modification for a struggling family isn't an act of charity. It's a strategic move. It pushes the potential default further into the future, allowing the servicer to collect their base fee for longer, while positioning them to cash in on a cascade of penalty fees the moment the homeowner stumbles again. Which, given the negative amortization risk we discussed, is highly likely. And there's yet another layer of armor protecting the lenders: insurance. If you put down less than 20%, you're forced to pay for private mortgage insurance or PMI. If you have an FHA loan, you pay a mortgage insurance premium for the life of the loan. This insurance doesn't protect you. It protects the lender. If you default and the home is foreclosed upon, the insurance company pays the lender a massive portion of their potential losses. So let's recap the flow of money and risk. The original bank makes the loan, collects a fee, and sells it, wiping their hands of the long-term risk. Wall Street packages the loan into a security, sells it to investors, and collects massive fees. The investors who buy the security are often protected by a government guarantee, courtesy of the taxpayer. The servicer who manages the loan has a financial incentive to profit from your struggles through fees. And the whole thing is wrapped in an insurance policy that pays out to the lender if you fail. It is a masterpiece of financial engineering. A system so perfectly constructed to offload risk and privatize profit that the homeowner is reduced to the smallest, most vulnerable cog in a multi-trillion-dollar machine. The 40-year mortgage isn't just a tool for homeownership. It is the raw material, the fuel for this machine. It provides a long, predictable stream of interest payments from those who succeed, and a rich, fee-laden, and insured fallout from those who fail. The system doesn't care which category you fall into. It's designed to win either way. So if the lender is protected, the servicer profits from your struggle, and Wall Street has already cashed out with the taxpayer as the ultimate backstop. Who is actually left holding the bag? The answer is more shocking than you think, because it redefines what it even means to own your home in the 21st century. So let's pull back the curtain. The entities that package and sell these loans, the investment banks, the mortgage originators, they've already made their money. The government-sponsored enterprises, Fannie Mae and Freddie Mac, have provided the guarantees, pushing the ultimate catastrophic risk onto the taxpayer. But that's only in a full-blown collapse. The real grinding day-to-day risk, the one that plays out over 480 agonizing months, that falls squarely on one person. You, the homeowner. You are the one left holding the bag. But it's not a bag full of defaulted paper like in 2008. It's a bag filled with something far more insidious: phantom equity, decades of interest payments, and the complete erosion of what it means to own a home. This isn't just about debt. This is about a fundamental reclassification of the American homeowner. With a 40-year mortgage, you are functionally no longer a homeowner in the traditional sense. You are a renter with maintenance responsibilities. Think about it. For the first decade, sometimes even 15 years, your payments are almost entirely interest. You're paying the bank for the privilege of living in their asset, and in return you also get to pay for the new roof, the broken water heater, and the ever-increasing property taxes. You have all the liabilities of ownership with almost none of the early benefits. You're not building a stake in your future. You're servicing a debt in a home that you occupy. It's a paradigm shift from building equity to long-term debt management. The house isn't your asset. You are the bank's asset. You are the reliable 40-year revenue stream. Let's make this brutally clear with numbers. Imagine a $400,000 loan. On a traditional 30-year mortgage at 7% after 10 years, you would have paid about $225,000 in interest and you would have built up roughly $70,000 in equity. It's a slow start, but it's a meaningful stake. Now let's look at the 40-year version at a slightly higher rate, say 7.5%, which is common for non-traditional loans. After those same 10 years, you will have paid over $280,000 in interest. And your equity? You'd have built up less than $35,000. You paid $55,000 more to the bank just to accumulate half the ownership stake. You've been running twice as hard on the financial hamster wheel just to end up half as far. You've essentially lit tens of thousands of dollars on fire for the sole benefit of a slightly lower monthly payment. This creates what economists call the mobility trap. For generations, a home was a stepping stone. You'd buy a starter home, stay for 5 to 7 years, build some equity, and then sell it to move up or move to a new city for a better job. That upward mobility was the engine of the American economy. The 40-year mortgage shatters that engine. If you're only $35,000 in the black after a decade, what happens if the housing market is flat or dips by just 5%? Suddenly, your equity is wiped out. To sell your house, you'd have to write a check to the bank just to cover the realtor fees and the remaining loan balance. You are literally chained to your property. You can't move for that better job in another state. You can't downsize if you have a family emergency. You can't adapt to life's changes. The golden handcuffs of homeownership are now just cold, hard iron. Your home, the supposed symbol of freedom, has become your prison. And the timeline is where this goes from being a financial problem to a generational crisis. A 30-year mortgage, started in your early 30s, was designed to be paid off around retirement. It was the capstone of a working life. You enter your golden years with your single biggest expense eliminated. That was the deal. The 40-year mortgage obliterates that deal. If you get one at age 35, you won't be free and clear until you are 75 years old. You will be sending mortgage checks to the bank from your Social Security checks. The dream of a debt-free retirement is replaced with the reality of being a debtor until the day you die. This isn't just about you either. It's about the wealth you can't pass on. The single greatest driver of middle-class wealth accumulation in American history has been home equity. Parents used that equity to send their kids to college, to start businesses, or they passed on a paid-off home to the next generation, giving them a massive head start. The 40-year mortgage is a weapon of mass destruction against intergenerational wealth. You're not passing on an asset. You're passing on the remainder of a massive liability. You're not giving your children a foundation. You're giving them the tail end of your debt. It's a quiet, systematic dismantling of the financial ladder that previous generations were able to climb. We are moving from a model of wealth creation to a model of generational debt servitude. Beneath all the math and economics is a profound psychological toll. The feeling of being stuck. The quiet desperation of watching your loan balance barely move, month after month, year after year. It's a constant, low-grade financial anxiety that permeates every part of your life. Every major decision, changing careers, having another child, caring for an aging parent, is viewed through the lens of this colossal, unyielding debt. It stifles risk-taking. It discourages entrepreneurship. It grinds people down. A home is supposed to be a source of stability and security, a sanctuary. But when it's financed this way, it becomes a source of perpetual stress, a monument to a financial mistake that will take half a lifetime to correct. So when we ask who is holding the bag, the answer is clear. It's not a Wall Street trader or a government agency in some far-off crisis. It's the family trying to make ends meet. It's the individual who dreamed of owning a piece of America and was handed a 480 payment ball and chain instead. They're holding the bag not in a sudden collapse, but in a slow 40-year bleed. The system has been perfectly designed to extract the maximum amount of wealth over the longest possible period, all while convincing the homeowner they've been given an opportunity. It is the most brilliant and most brutal of financial illusions. The individual homeowner then is trapped in a state of financial undeath. Not a renter, but not truly an owner either. They exist in a purgatory of debt, servicing a system that has already moved on. But what happens when this isn't just one person or one family? What happens when millions of households are locked into this exact same trap? The consequences escalate from a personal tragedy to a national catastrophe, locking the entire American economy into a dangerous cycle from which there may be no easy escape. This isn't a hypothetical scenario. It's the inevitable endgame of normalizing the 40-year mortgage. When an entire generation is funneled into these financial instruments, the American economy doesn't just slow down. It seizes up. The engine of our prosperity has always been the upward mobility of its citizens, and a key part of that is building wealth through home equity. The 40-year mortgage systematically dismantles that engine piece by piece. Imagine a housing market frozen in place. The natural cycle of life. Getting a starter home, building a family, upsizing, and eventually downsizing for retirement. That entire ladder crumbles. Why? Because for the first decade or even longer, homeowners in 40-year loans are effectively renters paying interest to a bank. They build almost no equity. They can't sell and move for a new job without bringing cash to the table to pay off the loan. They can't upgrade to a bigger home for their growing family. They are trapped. This creates a nationwide gridlock. The supply of existing homes for sale dries up because nobody can afford to move. This artificial scarcity then drives prices even higher for the few homes that are on the market, shutting out first-time buyers and creating a vicious, self-perpetuating cycle of unaffordability. Now let's zoom out from the housing market and look at the wider economy. Consumer spending accounts for nearly 70% of the US GDP. It is the lifeblood of our country. But what happens when millions of households have their disposable income siphoned off by an extra decade of mortgage interest payments? That's money that isn't being spent at local restaurants, on new cars, on family vacations, or on starting a small business. It's a slow 40-year drain on the economic vitality of the nation. Every dollar paid in extra interest is a dollar not invested in a new company, a dollar not used to innovate, a dollar not spent creating jobs. The 40-year mortgage acts as a massive long-term tax on the middle class, with all the proceeds going directly to the financial sector, stifling broad-based economic growth for decades. And this brings us to the most terrifying risk of all: systemic collapse. We saw what happened in 2008 when the system was flooded with risky, low-equity loans. The 40-year mortgage is that same concept but on steroids and disguised as a solution. When the next inevitable recession hits and people start losing their jobs, what happens? Homeowners with these loans will have zero equity buffer. They can't sell. They can't refinance. They will be underwater almost immediately. Mass defaults would become a certainty. But this time the problem is bigger. The loans are larger, the terms are longer, and the bank's balance sheets would be clogged with these ultra-long-term, low-quality assets. The shockwave would be catastrophic, making the 2008 crisis look like a minor tremor. It's a house of cards built on a 40-year foundation of sand. So you have to ask yourself the most important question. If this instrument is so damaging to the individual, so crippling to the housing market, and so dangerous for the national economy, who does it actually benefit? Who is pushing for this? The answer is brutally simple. The 40-year mortgage is not designed to help you. It is designed to maximize the profits of the lender. Think about it. A bank is in the business of selling money and charging interest. The longer they can keep you in debt, the more interest they collect. By extending a loan from 30 to 40 years, they aren't just getting 10 more years of payments. They are front-loading their profits by ensuring the first decade of your payments is almost pure interest. You are taking on all the risk of homeownership, the maintenance, the taxes, the market fluctuations, while the bank reaps the reward with minimal risk. It is a masterclass in financial engineering that transfers hundreds of thousands of dollars in wealth from your pocket, from your family's future, directly to their bottom line. They are selling you the illusion of affordability today in exchange for a lifetime of your wealth tomorrow. They are betting on the fact that you will only look at the monthly payment and not the total cost. And historically, that has been a very, very good bet for them. This entire situation is not a solution to the housing crisis. It's a symptom of a much deeper disease. The problem isn't that loan terms are too short. The problem is that home prices have become fundamentally disconnected from average American wages. Pushing the debt further into the future doesn't solve that. It institutionalizes it. It normalizes the idea that it should take nearly an entire working life to pay for a basic necessity. It is a quiet surrender, an admission of defeat. But we do not have to accept this. The real solutions are harder, they are more complex, but they are the only ones that will actually work. It starts with addressing the root causes. We need to build more housing, period. We need to reform restrictive zoning laws that artificially limit supply and drive up prices. We need to curb the institutional investor appetite that turns single-family homes into assets on a spreadsheet, competing directly with real families. These are the big structural changes we must demand from our leaders. But you are not powerless. On a personal level, the solution is to reject the premise entirely. The path to real wealth and financial freedom is not through finding clever ways to take on more debt for longer. It's through discipline and a shift in perspective. It means focusing intensely on the fundamentals, increasing your income, ruthlessly eliminating high-interest debt, and saving aggressively for a larger down payment to reduce the amount you need to borrow in the first place. It means challenging the very idea of the dream home. Maybe the dream isn't a 3,000 square foot house with a 40-year chain around your neck. Maybe the real dream is a smaller, more affordable home that you can pay off in 15 or 20 years. Maybe the real dream is financial independence, the freedom to change careers, to travel, to start a business, to retire with dignity. Freedoms that are impossible when you are a servant to a 4-decade mortgage. You have to learn the language of your enemy, interest. You need to understand what an amortization schedule is really showing you. You need to see with your own eyes how an extra $100 a month paid towards principal can shave years, even a decade, off your loan and save you a fortune. Financial literacy is not a suggestion. It is your armor in this fight. Ultimately, the 40-year mortgage is a test. It's a test of whether we will choose the illusion of immediate gratification over the reality of long-term prosperity. It offers a deceptively easy path, but that path leads off a cliff. The truth is, there are no shortcuts to building real, lasting wealth. It's earned through hard work, smart choices, and a refusal to be a pawn in someone else's financial game. The American dream is not about the size of your house. It's about the scope of your freedom. And the 40-year mortgage isn't a key to that dream. It's the key to a prison cell, locking you into a lifetime of debt. The choice is whether you want to own your home, or you want your home to own you for the next 40 years. Choose freedom.